Of course, the big challenge at the moment is the affordability crisis. In fact, a lot of people are struggling to pay for ends meet, let alone buy real estate. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to dig into really the ideas of where can we find capital growth in the marketplace. Of course, finding opportunities, finding the path forward when it comes to making sure we're going to put some equity, put some growth into our back pocket is an important principle. And I think I've taught many times a couple of ways to go about doing that. But today I want to talk to you about some concepts around consumer surplus. The idea that really real estate is driven from the accessibility of consumers to spend more, to pay more for real estate. So where will that come from? How will consumers over the next couple of years be able to afford real estate, given we are in a real estate affordability crisis? So let's have that conversation. Will there be no capital growth, or is it just a matter of actually looking at how consumers will behave and where they will behave and follow those patterns for successful capital growth? That's what today's show is all about. So welcome back, regulars. You know the drill. Play the program in double speed, get your life back. And of course, all the episodes are done are lessons on real estate. So feel free to go back in time, check out some past episodes of the Urban Property Investor. But hey, I'm well. I'm just back from a big trip away for work. There's been some good things happening out in the real estate world. So it's always exciting to get out and about. I think that's the best thing about real estate. You get to go to some kooky places and see some kooky real estate at times. And I've seen some, real kooky stuff of late. But equally, there is some good real estate out there which is going to make people money. But when it comes to the concept of capital growth obviously comes from the marketplace. And the marketplace is made up of people. Yes, primarily people provide the impetus of capital growth. Of course, the big challenge at the moment is the affordability crisis. In fact, a lot of people are struggling to pay for ends meet, let alone buy real estate. And of course, we've had a rate cut, a good old-fashioned rate cut. And of course, a lot of people will highlight that when rates lower, prices tend to increase because of this thing called a consumer surplus. If consumers have more cash in their back pocket, they're likely to spend it. So if we think about real estate in that platform, what consumers have extra creates capital growth. We can start to create a framework of effectively where and how capital growth might evolve. So I want to go through the big 10 of really the idea of a consumer surplus, of creating growth from real estate, thinking about it from a dynamic of what do people have extra and spare, which is going to push capital growth. If everyone's broke, growth ain't happening. If a suburb's effectively are a place where people aren't paying more for property, it's because typically they don't either like that real estate or there is a surplus issue of what people can afford to spend on real estate. So let's start with the probably easiest two. And I would have to give these ones a big cross when it comes to, are they going to perform? The first one is lower interest rates. Lower interest rates do actually create capital growth. There's been some great studies by many institutions around the rate of capital growth that occurs when you drop interest rates. And effectively, for every 1% drop in interest rates, there's usually a correlation of about 6% capital growth. Now, we've just had 0.25% rate cut. It's highly likely we might get 1 or 2 rate cuts by the end of the year. So potentially a consumer surplus of growth might come from lowering interest rates. That will mean people have more money in their back pocket, and because they've got more money in their back pocket, they are going to be able to spend that on housing. But I will say low rates aren't coming back to the way they were, certainly through the COVID period. So I think we can put a bit of a cross on that. It will help. Let's consider it the icing on the cake, not the cake. Now, the other thing that creates a consumer surplus of the ability to spend more for real estate is wage growth. Wage growth. Now, wages are growing, but they get really equalized through inflation adjustment. In other words, the economy is inflating at 2 to 3%, meaning your wages need to rise by 2 to 3% for you to use excess wages to fund buying real estate and paying more for it and creating capital growth for those people that already have it. Or vice versa. You've got real estate, wages are growing in the society. That's great. We want wage growth to keep up with inflation. But really, we have to put a bit of a cross around whether wage growth is going to create an extra ability or an extra surplus of consumers' ability to buy real estate and pay more for it. And that's where capital growth comes from. So I'm going to put it across through those two situations. But we can certainly look at the most traditional version of consumer or consumer surplusing. And that is really buying real estate well. If you can get some real estate below its intrinsic value, below its market value, you obviously create a surplus of growth through the real estate. Now, I recently did a deal whereby we got 36% off the real estate by virtue of square meter rates, something like 22% off the real estate by virtue of dollar figure. Really, that safety buffer, if you like, is going to create a surplus of basically growth out of the real estate. It was discounted so much that it was discounted below market value. So the investor will be able to recycle that value or get that property valued again and get a surplus of capital growth. So certainly buying real estate well is a principle of getting the right surplus for a consumer, as is adding value, and the right property where you can add value, whether it's through just buying it well or building a property or renovating a property, can certainly create equity. And in my Forex growth plan, we often refer to that as deal growth. But will I give that a big tick, those two deals? Are there deals to be done out in the real estate market? Well, there certainly is all the time, but you need to know what you're doing. 1 in 20 deals that I look at, I tend to bring on through our business. So that means 19 out of 20 don't have a very good look and feel to them when it comes to their ability to provide capital growth to people. So if we look at some other ways to create a surplus equity growth out of real estate, certainly when it comes to, I think, the idea of the disposable wealth market, it's really strong. It's really strong. So what that is not just income, that's income plus equity. And I think you're going to find that this group or cohort gets stronger. As there is a wealth transformation unfolding, people with money passing away and passing on their money to a younger generation, as well as a lot of people who've got wealthy out of buying real estate through the last 25 years of the wealth effect, has now a lot of equity. But equally, a lot of those people still have high disposable incomes. And I think where those people own real estate into the future is going to actually be a place where there's a consumer surplus. In other words, particularly those people who own their PPR in certain suburbs will continue to upgrade those PPRs using a mixture of wealth being equity and income. And I like to study really affluence. Where is affluence going? And if the right affluence makes up a large proportion of a neighborhood and the neighborhood itself is effectively under that concept, I know there is a lot of ability for that localized consumer to have surplus money. That surplus money, if reinvested in the local area, creates this kind of butterfly effect of higher house prices. And really, when you look at the counter argument of a neighborhood or a socioeconomic group which has no wealth and low income, that's not going to provide a level of a surplus for those consumers in that area. And I think you'll find that certain pockets basically can't grow in real estate because the people inside those areas are not going to be able to fuel growth. Growth might come from people coming from outside the area to inside the area, which is a bit of the halo effect. If the suburb is something that is a magnetic pull, you can get the disposable wealth market relocate their money through the concept of gentrification into a neighborhood. And of course, the halo effect, if you like, is a great effect. And I think it's going to provide capital growth for the marketplace. But the halo effect is all about identifying suburbs whereby the gentry, the higher, wealthier class, see it as the next best option. And of course, there are only so many of them that really evolve every single year. There's always a couple of suburbs that get onto the gentrification ladder. But certainly, if you bring outside money into a suburb that is really going through transformation and change, you can actually get a lot of capital growth. And all that is surplus consumer demand coming into a neighborhood. So we know that interest rates may help. We know wage growth probably won't help at this point in time. We know we can always add value to real estate to create surplus growth. We know we can buy real estate below market value to add value to surplus growth. We certainly do understand that the halo effect of money coming from outside a neighborhood, inside a neighborhood, will create a surplus of the ability of consumers to pay more for real estate. Really, we do see this a lot with geo-lifestyle arbitrage. The idea that if a suburb or a town or a place is full of lifestyle and it's considered underpriced, you're going to get people have the ability to look at that marketplace and relocate. And we're seeing a lot of that through digital work. If a suburb has great ability to get to work in the CBD within perhaps a property within 125 kilometres from a CBD, but equally where the residents are affluent and there is this lifestyle worker now moving into that neighborhood. They're bringing their CBD income quite often from the financial hubs of places like Sydney, Melbourne, and Brisbane to these lifestyle, quite often coastal suburbs, and they're pushing the values up. Lifestyle arbitrage, lifestyle arbitrage, just geographical lifestyle arbitrage. And of course, that provides consumer surplus. That provides more money coming to a suburb, which means the suburb will probably go up in value. Property values will rise as outside incomes come in. That creates with it growth. So other than that, obviously you've got the idea of the affordability of the marketplace. And quite often this is the house price to income ratio. Now, certain places in Australia, the house price to income ratio is ridiculously crazy. Like, people in Sydney are spending 50% of their income on living in a home. There's not a lot of surplus income to push up property values. However, if you look at some of Sydney's gentrifying areas where the halo effect is happening, where lifestyle geo arbitrage is happening, you're getting an uplift of value. And so there's always anomalies to this kind of stuff. But equally, some markets around Australia, the income versus house price ratio is very sustainable for future capital growth. And some do argue really the Perth property market has been going through this for a couple of years, had highest incomes in Australia and the lowest house prices there for quite a while. And probably if you're looking for a marketplace which is going through a similar pattern to that of Perth, you could argue the Melbourne market now has low house prices in its cycle and reasonable wages. So really that metric of affordability can find a surplus consumer demand. And we certainly found that in Perth. We found that high incomes, low property values, and you get surplus ability for the consumer, aggregate demand to pay more for real estate. So we've been through low interest rates, we've been through wage growth, we've been through market affordability, geo arbitrage, the halo effect, adding value to real estate, buying real estate below market value, and then there really are a couple more. And the next one effectively is spatial transformation or redistribution. And really what that is a large cohort of people going, I've got money, I'm going to redirect that money out of one asset into another asset. And probably the quintessential mover and shaker in this space at the moment is the downsizer marketplace. Lots of money, lots of wealth, primarily all cash. Obviously, also moving money out of effectively their PPR into selling their PPR and even relocating, or even just tapping their abundant amount of 60 and 70 years worth of working and equity creation and buying different real estate. A lot of that is directed at luxury 2 and 3 bedroom apartments. And really you're seeing again, there's surplus consumer money create capital growth in certain typologies, extra surplus money going into the marketplace. Now, we will get some extra surplus money also coming out of the government. Government is giving away money, homeowner grants and things like that. And of course, that creates a level of extra consumer surplus. They don't have to spend money on stamp duty. And so you get this kind of push effect into the housing marketplace. So again, we've got to look for these signals as to where things are going, because Probably interest rates will come down a little bit further, but it certainly won't go back to the era where money was basically free. Wage growth, it's kind of frozen against inflation. So though it's helpful against inflation, it quite often doesn't beat the inflation demon. So we can look at the neighborhood effect, effectively those high local income neighborhoods where the income versus house price is very similar to the affordability metric around major markets having a house price versus income ratio. Suburbs also have a house price versus income ratio. And again, we can see if the right neighbors are earning well, there is this natural tendency to want to keep buying in the local neighborhood. You do get this kind of turnover of stock where people want to move to the better street or get the sunnier backyard or love where they live, but just want to find the best localized housing solution for themselves. And of course, that is surplus consumer activity that leads to quite often capital growth. So demand, it's an interesting thing because if demand has no money, it's not necessarily going to create capital growth. But if new demand comes to a marketplace and it's got an excess amount of extra money to spend, it will create opportunity. It will create capital growth into the market itself. So the ones I've been following, and I'll just explain the ones I've been following because I think they're really the ones which are going to make people money, is doing a deal. Doing a deal is probably the easiest way to make money, just finding a good price in the market, something undervalued, and you get this ability or hit on consumer as a consumer surplus. You can make your own money, manufacturing equity, I guess you would say. I also am looking at geo lifestyle arbitrage, these arbitrage suburbs where I know incomes are moving to are going to push property values up. I think from an affordability, house price versus income ratio at a market level, your places like Perth and Melbourne give you probably the best bang for your buck. Certainly from the halo and neighborhood effect, it's something I always study. Is there high incomes in a neighborhood, and would more people with money come to a neighborhood and gentrify it? I think that's working really, really well. I think you've got to consider the overall wealth position of the society. You know, there are just wealthier pockets which are going to continue to do really, really well by virtue of equity and income. And as we know, spatial transformation drives real estate growth. And if we can take a wealthy baby boomer, trade in their wealthy, most expensive house going around and redeploy a lot of that money, not even using leverage, but typically cash, if you can find out where that money is headed, and quite often it is into some of these sort of lifestyle precincts, you typically see a correlation of them splashing surplus cash, pushing the prices up on real estate. So lots to be said for the basically disposable wealth market. A lot of them are buying at auction at the moment. You're seeing even families team up together where younger people have the income, older family members are giving equity or larger deposits, and you're seeing the push on those price values. You know, 3-bedroom townhouses in Sydney at the moment are just going gangbusters. There's a combination of not just incomes paying 1.5 for those pieces of property, it's income plus family wealth or equity, which is pushing up the value. So that's it. That's surplus income. And I think the reason I wanted to do today's show is interest rates. lot of people are banking on interest rates coming down for capital growth to be a thing. Whilst that is true, whilst that can happen, what if it doesn't happen? That's the argument. What if it doesn't happen? The counter argument. How about you buy well, look for geo lifestyle arbitrage, find an affordable overall market, find an affordable overall suburb with higher incomes, find redistribution of spatial change. All of that will lead to capital growth. All right, folks, that's it from me. I hope that was interesting. We'll be back. We'll be back next week to talk more property investment. But for now, that's it from me. Over and out until we talk property one more time. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.